Something deeply unsettling is unfolding across corporate America right now. The household brands we grew up trusting, the very companies that built massive empires, employed millions of people, and became woven into everyday life, are quietly falling apart from within. Beneath the polished commercials and billion-dollar logos sits a far less glamorous reality: mounting debt, shrinking sales, and consumers who have simply stopped caring and moved on. And this collapse isn't happening in isolation. As the U.S. economy inches closer to a full-blown recession, even the largest and most powerful corporations are starting to crack. Layoffs, bankruptcies, and evaporating profits are no longer hypothetical risks looming on the horizon. They've become routine, expected, and disturbingly normal. Number 15. Paramount Global. Once considered a powerhouse of Hollywood, Paramount Global is now buckling under a failed entertainment strategy and a mountain of debt. This is the same company that delivered cultural staples through CBS, MTV, and Nickelodeon, brands that once defined entire generations. Today, however, Paramount is struggling to keep its head above water as the streaming wars drain its resources. The numbers tell a brutal story. In 2023 alone, Paramount Plus burned through more than $1.6 billion, while ad revenue across its traditional TV networks dropped by nearly 10%. What was once its most reliable cash machine, cable subscriptions, has completely unraveled, plunging more than 25% in just 3 years. On top of that sits a massive $15 billion debt load, now acting like a financial time bomb. Rising interest payments are chewing through already shrinking profits, leaving executives with few options beyond aggressive cost-cutting. Layoffs have spread across the company, morale has taken a hit, and entire creative teams have been dismantled. In some divisions, as much as 25% of the workforce has already been eliminated. Original content projects have been shelved, and valuable assets have been sold off simply to keep the lights on. Investors haven't been spared either. Paramount's stock has collapsed more than 80% from its 2019 peak, erasing billions in shareholder value and signaling a severe loss of confidence in the company's future. In an industry now dominated by streaming giants like Netflix and Disney, Paramount increasingly looks like a relic, trying to survive on nostalgia rather than innovation. The audiences that once turned MTV and CBS into cultural icons have largely moved on, leaving Paramount dependent on aging franchises and outdated distribution models. Industry analysts are blunt in their assessment. Without a major acquisition, merger, or financial rescue, Paramount may not last another 2 years in its current state. What was once a sprawling, multi-platform entertainment empire is now a struggling brand barely hanging on. A stark reminder that in today's unstable economy, even the most legendary names in entertainment are not immune to collapse. Number 14. Nordstrom. Nordstrom, once a defining name in American luxury retail, is now quietly unraveling. Stores that used to buzz with affluent shoppers and high-end labels feel eerily empty today, a sharp contrast to their former prestige. Revenue has slid from $15.5 billion in 2019 to just over $13 billion in 2024, and along the way, profit margins have all but disappeared. But inflation isn't the real problem. Irrelevance is. As shoppers migrate toward discount chains like TJ Maxx or the convenience of online giants such as Amazon, Nordstrom's upscale positioning has turned from an advantage into a liability. Its premium image no longer resonates with a consumer base that's watching every dollar. The company has already shuttered dozens of stores, including its once iconic San Francisco flagship, citing rising crime, weak foot traffic, and costs that no longer make sense. Online retail was supposed to be the lifeline, but that hope has faded too. E-commerce growth has slowed to a crawl, while fulfillment and logistics expenses continue to climb. Even Nordstrom Rack, the company's discount division, hasn't escaped the downturn. Sales there fell nearly 8% last year as consumers tightened their budgets even further. Wall Street has taken notice. Nordstrom's stock, which once traded above $65, now struggles below $15, a staggering loss of roughly 75% in value. Inside the company, leadership is scrambling. Layoffs, debt restructuring talks, and so-called strategic reviews are underway, which in corporate terms usually signals one thing: panic. The middle class that once powered Nordstrom's rise is being squeezed out, overwhelmed by soaring rent, grocery prices, and mounting credit card debt. Meanwhile, wealthy shoppers have shifted their loyalty to ultra-luxury brands, leaving Nordstrom stuck in an uncomfortable middle ground. Too expensive for everyday consumers, yet not exclusive enough for the elite. Some analysts warn the retailer could soon follow the path of Neiman Marcus and JCPenney into bankruptcy court. For a brand that once embodied American sophistication, this collapse goes beyond balance sheets and stock charts. It's symbolic. The dream of accessible luxury is fading, and Nordstrom appears to be going down with it. Number 13. Carvana. Carvana was once pitched as the Netflix of car buying, but what it delivered looked far more like a financial nightmare. During the pandemic-fueled boom, the company's valuation soared to nearly $60 billion. Today, that figure has collapsed by more than 95%, leaving its market cap hovering around just $2 billion. The futuristic car vending machines and glossy marketing couldn't mask the underlying problems: crushing debt, a free-falling used car market, and a business model that only made sense when money was cheap and demand felt endless. At its height, Carvana moved more than 400,000 vehicles a year. By 2024, sales volume had dropped by almost a third. As interest rates surged and auto loans became harder to secure, buyers pulled back fast. That pullback was amplified when used car prices plunged more than 20%, wiping out margins and shaking consumer confidence. The financial strain is severe. Carvana is carrying more than $9 billion in debt while continuing to post annual losses near $1 billion. Analysts have repeatedly raised red flags, warning that the company may be running out of cash just to keep day-to-day operations afloat. In a desperate bid to survive, Carvana has taken drastic steps. The company has laid off over 4,000 employees, nearly 20% of its workforce, and even attempted to sell off parts of its loan portfolio to maintain liquidity. But as repossessions climb and potential buyers disappear, investors are increasingly calling it what it is: a speculative bubble that already burst. The concept was bold and exciting. Buy a car online and have it delivered straight to your driveway. But execution told a very different story. With higher interest rates, collapsing demand, and a toxic debt load weighing it down, Carvana's once promising empire is sinking fast. For a company built on big dreams and borrowed money, the crash isn't coming. It's already underway. Number 12. Peloton. Peloton was once the ultimate winner of the pandemic fitness boom, a $45 billion superstar that claimed it would redefine how people worked out forever. But once gyms reopened and daily life returned to normal, that carefully built empire began to unravel almost immediately. What looked unstoppable during lockdown quickly collapsed when reality set in. Today, Peloton's market value has fallen below $2 billion, representing a staggering 95% loss from its peak. Sales of its flagship bikes and treadmills have dropped more than 35% year over year, while the company continues to hemorrhage cash. In 2023 alone, Peloton reported a net loss of roughly $1.2 billion, underscoring just how deep the damage runs. What was once Peloton's strongest asset, its subscription model, is now working against it. As inflation squeezes household budgets, customers are canceling costly monthly memberships at a growing rate. On top of that, a series of expensive product recalls, including one involving 2.2 million bikes, severely hurt the brand's reputation and drained even more cash from the business. In response, Peloton has been forced into survival mode. More than 6,000 employees have been laid off, physical showrooms have been shut down, and the company has even started selling its bikes on Amazon, something that would have been unthinkable during its peak. But none of it has been enough to turn things around. The harsh truth is that consumer behavior has shifted. Few people are willing to spend $1,500 on a premium exercise bike when second-hand models are flooding platforms like eBay for a fraction of the cost. Peloton has tried pivoting into software, corporate wellness programs, and hotel partnerships, but those moves have failed to stop the bleeding. The stock price tells the story clearly. Shares that once traded near $170 now struggle to stay above $5, and investor confidence has largely evaporated. Peloton's downfall isn't just about bad financial decisions, it's a cultural collapse. A brand built on hype, Luxury pricing and lockdown convenience simply couldn't survive in the real world. And as the economy tightens further, Peloton appears to be pedaling straight toward bankruptcy. Number 11. GameStop. GameStop used to be a defining part of growing up as a gamer. Today, it stands as a symbol of how fast retail can fade into irrelevance. A company built on selling physical game discs has run out of room to survive in a world that's gone almost entirely digital. Revenue has slid from $9.2 billion in 2018 to less than $5 billion in 2024, and the company still can't escape ongoing losses. Even the infamous meme stock explosion that briefly sent shares skyrocketing to $480 wasn't enough to change its long-term trajectory. That surge defied logic, but gravity eventually returned. Now, the stock trades below $15, and the excitement that once surrounded it has completely evaporated. The core problem is simple and brutal. Gamers no longer need physical stores. More than 85% of video game sales now happen digitally, leaving brick-and-mortar retailers with little purpose. GameStop has tried reinventing itself again and again, launching NFT marketplaces, pushing PC hardware, and leaning heavily into collectibles. But none of these pivots produced consistent, sustainable profits. As a result, thousands of stores have been closed, and layoffs continue across North America. The massive Reddit-fueled frenzy of 2021, once praised as a financial uprising, ultimately did little more than buy the company some time. The underlying issues never went away. Now, that time is running out. Cash reserves are shrinking, operating costs remain high, and analysts warn that just one more year of declining sales could push GameStop dangerously close to bankruptcy. What was once the cultural hub for gamers has turned into a nostalgic reminder of a bygone era. In an economy where every dollar matters, buying used games isn't saving GameStop anymore. It's accelerating the decline. And at this point, the final game over screen may already be loading. Number 10. Warner Bros. Discovery. Warner Bros. Discovery was meant to become a dominant force in Hollywood after its massive $43 billion merger. Instead, the company has spiraled into disorder, weighed down by layoffs, strategic confusion, and more than $47 billion in debt. What was supposed to be a media superpower has turned into a case study in how quickly ambition can go wrong. This is the same company that controls HBO, CNN, and DC's film universe, yet it now represents everything broken in modern media management. In 2023 alone, streaming losses topped $1.6 billion, while box office returns from once dependable franchises like The Flash and Aquaman severely underperformed. At the same time, traditional cable networks continue to hemorrhage subscribers quarter after quarter, and advertising revenue has dropped by more than 12%. Much of the turmoil traces back to leadership decisions. CEO David Zaslav has pushed relentless cost-cutting measures, from canceling nearly finished movies to executing widespread layoffs. Inside the company, morale has cratered, and many employees describe the environment as constant crisis management rather than long-term strategy. Even the attempt to simplify streaming backfired. Rebranding HBO Max into Max confused audiences, diluted one of the strongest brands in entertainment, and failed to stop subscriber losses. While competitors like Netflix and Disney Plus continue to dominate the global streaming market, Warner Bros. Discovery is still losing ground. Investors have responded harshly. Since 2021, the company's stock has fallen more than 75%, reflecting Wall Street's lack of confidence in its direction. Analysts increasingly argue that the only realistic path forward may be a fire sale of assets or a last-ditch merger. But there's a problem. In today's economy, few companies are eager to take on another media giant buried under debt. Warner Bros. Discovery once stood as a symbol of Hollywood power and prestige. Now it looks more like a sinking ship, dragged down by its own oversized ambitions. What was once one of entertainment's most respected names has become a warning label. When a company tries to chase everything at once, it often ends up losing it all. Number 9. Big Lots. Big Lots was once a familiar stop for Americans looking to stretch their dollars on furniture and household essentials. Now, it's become a cautionary tale of a discount retailer in free fall. As inflation squeezes low-income shoppers harder than ever, even bargain hunters are pulling back. And Big Lots is paying the price. In 2024, the company reported a staggering $462 million loss as sales collapsed by 13% year over year, marking its worst performance in decades. With more than 1,300 locations still operating, many stores are now bleeding cash. Management has already shut down dozens of locations and openly warned investors that there is substantial doubt about the company's ability to remain in business. The balance sheet offers little comfort. Big Lots is carrying more than $1.1 billion in debt, while its cash reserves have nearly dried up. Investors have responded accordingly. Shares that once traded close to $70 now sit below $4, a brutal 94% collapse that signals serious bankruptcy risk. Rising rents, higher labor expenses, and increasing shipping costs have turned what was supposed to be a low-cost retail model into a financial trap. Even liquidation-style sales have failed to bring shoppers back, as customers instead gravitate toward Walmart, Dollar General, or online platforms that can offer lower prices and greater convenience. In an economy where middle-class families are prioritizing rent, groceries, and utilities over furniture and decor, Big Lots' core business no longer fits the moment. While the company's CEO continues to promise a turnaround, Wall Street sees those plans as overly optimistic at best. Big Lots was designed to survive when times were tough. But this downturn is different. Money isn't just tight, it's exhausted. And with one more bad quarter, Big Lots could become the next retail name to quietly disappear from American streets. Number 8. Jo-Ann Fabrics. Jo-Ann Fabrics, the century-old craft retailer once cherished by hobbyists and home creators, is coming apart faster than the fabric lining its shelves. After years of sliding sales and mounting pressure, the company found itself buried under more than $1 billion in debt, ultimately forcing a Chapter 11 bankruptcy filing in 2024. For generations, Jo-Ann was a go-to destination for creative Americans. But its traditional retail model couldn't withstand a brutal combination of soaring rents, weakened consumer spending, and a sharp post-pandemic collapse in DIY demand. During lockdowns, mask-making and at-home crafting briefly reignited sales and gave the company a lifeline. Once those trends faded, however, so did much of its customer base. Foot traffic dropped nearly 20%, and inflation pushed even basic, low-cost fabrics out of reach for casual shoppers. In 2024, the average American household cut discretionary spending by roughly 9%, dealing a major blow to Jo-Ann's already razor-thin margins. The company responded with store closures, layoffs, and an attempted shift toward online sales. But that pivot came too late. Giants like Amazon and Walmart now dominate the craft supply market, leaving Jo-Ann struggling to compete. E-commerce accounts for less than 15% of its total revenue, nowhere near enough to compensate for collapsing in-store sales. Today, many Jo-Ann locations feel abandoned. Massive retail spaces sit filled with clearance racks, empty aisles, and an unsettling quiet. Even private equity backers have walked away, writing off their investments as total losses. What was once a comforting and familiar brand for makers and crafters has become another victim of a shrinking middle class. The American hobby dream, creative, personal, homemade, is slowly fading. And as that dream unravels, Jo-Ann Fabrics is unraveling right alongside it. Number 7. Red Lobster. Red Lobster, once a symbol of affordable indulgence in American dining, is now rapidly sinking beneath the surface. The casual seafood chain has shuttered dozens of locations across the country after posting losses exceeding $11 million in just a single quarter of 2024. What was once a reliable restaurant staple is now fighting for survival. A perfect storm of rising food prices, labor shortages, and poorly executed promotions has crushed profitability. The infamous endless shrimp deal, meant to bring customers back, instead became a financial disaster. Shrimp costs alone jumped nearly 30%, while rent at prime restaurant locations continued to climb. With debt topping $300 million and roughly 650 restaurants still operating, many locations are barely keeping their doors open. Customers who once viewed Red Lobster as a go-to spot for birthdays and special nights out are now staying home. In an era of tight budgets and relentless food inflation, $25 shrimp plates no longer feel reasonable. They feel extravagant. As wallets shrink, discretionary dining is often the first thing cut. Ownership turmoil only accelerated the collapse. Thai Union, Red Lobster's primary investor, walked away entirely, publicly calling the business financially unsustainable. Analysts now warn that if closures and layoffs continue at the current pace, a full bankruptcy filing could happen within the next year. The downfall is especially painful because Red Lobster helped define American casual dining in the 1990s. Those cheddar biscuits, family celebrations, and endless seafood platters were once part of the cultural fabric. Today, that nostalgia isn't enough to fill tables. With wages lagging behind prices and the middle class under pressure, comfort dining has become a luxury many can no longer justify. Red Lobster's decline isn't just about shrimp or mismanagement. It reflects a broader reality. In a shrinking economy, Americans simply can't afford casual luxury anymore. Number 6. Rite Aid. Rite Aid, one of the oldest pharmacy chains in the United States, is buckling under the combined pressure of crushing debt, massive lawsuits, and relentless competition. In 2023, the company officially filed for Chapter 11 bankruptcy, revealing more than $3.3 billion in liabilities and announcing the closure of over 500 stores across the country. This collapse didn't happen overnight. It was years in the making. While competitors like CVS and Walgreens invested heavily in digital prescriptions, retail health clinics, and streamlined operations, Rite Aid remained stuck in the past. Its stores failed to evolve, and customers noticed. Same-store sales fell by roughly 9%, while supply chain expenses jumped nearly 15%, squeezing margins even further. But the most devastating blow came from opioid litigation. Rite Aid faces more than 1,000 lawsuits tied to the opioid crisis, with potential liabilities reaching into the billions. An impossible burden for a company already struggling to survive. Investors fled long ago. Rite Aid's stock, which once traded near $180 per share, now hovers below $1. Inside the stores, the damage is visible. Layoffs and closures have left many locations understaffed, with customers reporting empty shelves, long waits at pharmacy counters, and declining service. Even longtime loyal shoppers are being pushed toward competitors simply out of necessity. Rite Aid's downfall isn't just another retail bankruptcy, it's a warning sign. When pharmacies can't remain profitable while selling essential medications, it points to something fundamentally broken in the healthcare system. Rising costs, legal exposure, and eroding public trust have created a situation few companies could survive. Analysts now believe Rite Aid's remaining locations may be sold off piece by piece, slowly erasing another once familiar American brand. It's a grim ending for a company that couldn't keep pace with a changing nation, and a troubling signal for the future of healthcare retail in America. Number 5. Macy's. Macy's, the brand that once defined American shopping culture, is now quietly drifting toward bankruptcy rumors. Long ago, its stores were the anchors of downtown life and suburban malls alike. Today, they're weighed down by disappearing foot traffic, soaring rent costs, and the slow death of the traditional department store. The financial slide is hard to ignore. Revenue has fallen from roughly $25 billion in 2019 to about $22 billion in 2024, while profitability has largely vanished. Investors have already rendered their verdict. Macy's stock, once considered a dependable blue-chip name, has plunged nearly 80% from its peak. The warning signs are everywhere. Since 2020, the company has shut down more than 150 locations, and plans call for another 125 closures by 2026. Even Macy's iconic flagship store in New York City, long seen as untouchable, is now operating on razor-thin margins, a shocking indicator of how deep the trouble runs. Attempts to reinvent the brand online haven't delivered the rescue executives hoped for. E-commerce giants overwhelmed Macy's digital efforts, siphoning off customers with faster shipping, better pricing, and seamless convenience. But the deeper issue goes beyond technology. Consumer behavior has fundamentally changed. Shoppers no longer want to wander endless aisles. They want one-click purchases, fast delivery, and steep discounts. Inflation only accelerated the decline, pushing even loyal Macy's customers toward cheaper alternatives like Target or ultra-fast online fashion brands. Add more than $3.2 billion in long-term debt to the equation, and Macy's increasingly resembles another retail dinosaur struggling to outrun extinction. Executives continue to talk about transformation and reinvention, but the reality is hard to ignore. As mall traffic collapses and the economy tightens, Macy's legacy of holiday parades and Red Star logos is being replaced by clearance racks and boarded-up storefronts. What was once a symbol of middle-class shopping joy has become a sobering reminder of what American retail used to be, and what it may never be again. Number 4. WeWork. WeWork was supposed to reinvent the modern workplace. Instead, it delivered one of the most spectacular corporate implosions of the last decade. Just a few years ago, the company carried a jaw-dropping valuation of $47 billion. By 2024, that illusion had collapsed entirely, ending in a Chapter 11 bankruptcy filing with less than $500 million in remaining assets. What began as a bold vision to reshape how people work has been reduced to empty offices, broken leases, and abandoned buildings. The core issue was baked into the model from the start. WeWork depended on cheap money, aggressive expansion, and non-stop growth to survive. When the pandemic hit, demand for office space collapsed. When remote work became permanent, it was game over. Occupancy rates fell below 50%, yet rent obligations still exceeded $10 billion. The math simply stopped working. Investors who once rushed in with blind confidence, most notably SoftBank, watched billions evaporate almost overnight. What followed was inevitable. Mass layoffs, mounting lawsuits, and properties left sitting empty across major cities. The company tried everything to delay the collapse. Debt restructurings, lease renegotiations, emergency cost cuts, but none of it fixed the underlying problem. In a post-pandemic world, demand for shared desks, open offices, and communal workspaces never recovered. What WeWork once marketed as a cultural movement now stands as a cautionary tale of unchecked ambition and corporate delusion. Its downfall mirrors the broader economy almost perfectly: overhyped, overleveraged, and fundamentally unsustainable. For an entire generation, WeWork promised freedom, flexibility, and collaboration. What it ultimately delivered were unpaid rents, broken startups, and ghost offices scattered across America. Number 3. Delta Airlines. Delta Airlines, long regarded as one of the most stable and well-run carriers in the United States, is now flying straight into serious financial headwinds. As post-pandemic travel demand cools, fuel prices surge, and labor tensions escalate, the airline's profits have dropped nearly 40% compared to last year, a sharp reversal for a company once praised for consistency. Debt has piled up rapidly. Delta now carries roughly $23 billion in obligations, the highest level in its history. And even with ticket prices at record highs, the airline is struggling to keep pace with runaway expenses. Jet fuel costs alone jumped about 35% in 2024, while new labor contracts added billions more to operating costs. Operational strain is showing everywhere. Flight delays and cancellations are increasing, customer frustration is climbing, and reliability metrics are slipping. Meanwhile, demand is weakening on multiple fronts. Domestic leisure travel has stalled as middle-class families cut back on vacations, and corporate travel, once Delta's most profitable segment, remains roughly 25% below pre-2020 levels. With the broader economy slowing, airlines are being squeezed from all sides at once. Delta has already begun quietly trimming routes, postponing aircraft deliveries, and exploring new partnerships in an effort to preserve cash. These are not growth moves, they're survival tactics. Industry analysts warned that it wouldn't take much to push the airline into serious trouble. A sharp recession or another spike in oil prices could force Delta into restructuring, or worse, bankruptcy protection. Once held up as the gold standard of airline operations, Delta now reflects a much harsher reality. The airline industry is fragile, heavily dependent on debt, constant price increases, and consumers stretched to their limits. And in a weakening economy, even the strongest carrier may not have enough altitude left to ride out the storm. Number 2. General Motors. General Motors, the company that once embodied American industrial strength, is now edging dangerously close to a financial cliff. Even while selling millions of vehicles each year, GM is burning cash at an unsettling pace, weighed down by more than $118 billion in total debt and profit margins that continue to shrink. Electric vehicles were meant to secure GM's future. Instead, they've become a heavy drag on the business. The company has already poured roughly $35 billion into its EV transition, yet the payoff hasn't materialized. In 2024, electric models accounted for less than 3% of GM's total U.S. vehicle output, a sobering return on such a massive investment. Behind the scenes, the problems are piling up. Manufacturing plants are running below capacity, battery facilities are falling behind schedule, and ongoing supply chain disruptions keep driving costs higher. GM recently announced more than 5,000 layoffs as it scrambles to cut expenses. Meanwhile, dealerships are overflowing with unsold EV inventory, and even the company's traditional gas-powered models are starting to struggle. Rising interest rates have pushed average car payments to record levels, around $750 per month, pricing millions of Americans out of the market altogether. Auto loan defaults are climbing fast, up 27% year over year, signaling a sharp pullback in demand that could ripple across the entire industry. Adding to the damage, the United Auto Workers strike cost GM nearly $1.5 billion in lost production. Investors are growing uneasy. Since 2021, GM stock has fallen more than 45%, reflecting mounting concern about the company's direction and financial resilience. Analysts warn that if another deep recession hits, America's largest automaker could once again face the same grim outcome it did in 2009: bankruptcy. The American car dream that GM helped build isn't collapsing because people stopped driving. It's falling apart because fewer people can afford to keep driving at all. Number 1. Boeing. Boeing, once the undisputed crown jewel of American manufacturing, is now teetering on the edge of a historic collapse. A company that used to stand for innovation, engineering excellence, and safety has instead become associated with failures, scandals, and deep-rooted mismanagement. The aviation giant is buried under roughly $58 billion in debt, while its credibility and safety reputation has been badly damaged. The unraveling began with the 737 MAX disaster, a crisis that shattered global trust. Entire fleets were grounded worldwide, investigations exposed systemic failures, and the fallout cost Boeing more than $20 billion. But the damage didn't stop there. Production problems kept piling up: missing bolts, loose panels, fuselage cracks, each new revelation reinforcing the sense that quality control had collapsed. Airlines took notice. Orders were canceled, deliveries slowed, and even long-standing partners like United Airlines and Ryanair openly criticized Boeing's manufacturing standards, something that would have been unthinkable just a decade ago. The financial consequences have been brutal. In 2024, Boeing posted a $3.9 billion net loss, marking its sixth straight year in the red. The stock tells the same story. Shares that once traded near $440 now struggle to stay above $180, wiping out roughly 60% of the company's value. Aircraft deliveries are down, supplier costs keep climbing, and leadership controversies have pushed investors close to panic. Behind the scenes, Boeing has been quietly cutting back. Thousands of employees have been laid off, share buybacks have been suspended, and the company has leaned heavily on government support by securing long-term defense contracts just to stabilize cash flow. Even that safety net is fraying. Boeing's military and defense division is facing delays, cost overruns, and penalties of its own. For decades, Boeing was considered untouchable, a symbol of American engineering dominance and global industrial power. Today, it stands as a warning about what happens when profit pressure, corporate arrogance, and denial replace accountability. If the broader economy finally tips into a full-scale crash, Boeing may not simply stumble. It could drag much of the American aerospace industry down with it. What once seemed unthinkable is now increasingly plausible. The mighty Boeing isn't just losing altitude, it's heading toward a crash landing of its own making.